right. Good morning, everybody. Welcome back to another Fireside Chat at Foresight. This one, we're going to be talking about capital markets. It has been coming to the end of 2022, and it has been an exciting year in capital markets. So we've got some folks here to talk a little bit about some of their experiences, maybe some predictions for what 2023 will bring. And of course, we will continue to have more of these chats throughout the coming year as we need to always learn, need to always share experiences and chat to other folks in the industry. Next slide, please. It would be remiss of me if I didn't, put this massive orange thing on my screen to color my complexion, make me look a little healthier. But in all seriousness, I do want to acknowledge the First Nations lands on which we all operate here in Canada. Myself, I'm standing on the unceded territory of the Musqueam, Tsleil-Waututh, and Squamish nations, and I encourage everybody to acknowledge the lands on which they are working and operating from today. Next slide, please. What we're going to be doing, a little introduction. I will take a few minutes of your lives, as I've already started to do. Then we're going to move on to the panel, why you all came here today. Some fantastic folks. You already see them there on the screen, Tom, Dan, and Julie. We'll move into a roundtable discussion. As always, nobody comes to any Foresight event to talk to me. Sadly, I'm just not that interested. They came here to answer your questions. So I have some questions for them. They'll obviously be chatting to each other a little bit. But if you have your own questions, please do jump in the chat. Let them know what it is you're thinking, what it is you're concerned about, and how it is that they can kind of share their experience to make your life a little bit easier. And finally, I'll close off, let you know what's coming up for next year, what we're doing at the future Fireside Chats, and wish you all a happy holidays. That's how I'm hoping to wrap this thing up, because I can't believe it's the end of December. This year has just flown by. Next slide. Okay, I think you should all know what Foresight does if you ended here, but I would be remiss if I didn't repeat myself. We are Canada's Clean Tech Accelerator, and our goal is to rapidly launch, commercialize, and scale climate solutions. We do this with the help of our Helix 5 partners. That is the innovators, many of you on this call, our industry partners, investors, government, and of course, academia. So hopefully together, if we can all smooth out the communications between those groups, we can move quickly to see some scaled up climate solutions. Next slide. How we do this is our accelerator programs, right? We help innovators move their ideas into commercialized products. And of course, we have our innovation challenges where we help industry find the solutions that they need. If you're curious and you know anybody who might benefit from some acceleration, we are still recruiting for our winter cohort. So feel free to share that as well. We do focus on a few areas when it comes to helping the ecosystem. One of them is capital attraction. We're going to be talking about capital markets today. So that's, top of everybody's mind. You need money to grow things. Export development. While I love Canada as a home, as a place to start and build companies, I do know that if we want to have the impact that we need, we will need to take our solutions and sell them around the world. And so we try to make that front and center in everybody's minds and make that as easy as possible. And of course, that ecosystem building, it is not something that we're going to do. These are not problems we're going to solve in a silo. We do need help from all those Helix 5 members. And so we're trying to bring everybody together to make it as easy and smooth a process as possible. On our next slide, we'll be celebrating a little bit of the success we've had. These are the companies we've worked with. We've worked with over 900 SMEs over the last, since 2015. I guess that's 7 years. Time flies. Helped them raise over $1.25 billion, helped them sell a lot of money. And it's really to the passion and the hard work of the innovators that we have to thank those fantastic numbers. But that's only getting started. I think if we want clean tech to be a real cornerstone of the Canadian economy, we have to keep pushing forward. And I want to look back in 5 years and say, wow, that seemed impressive at the time, but look at the distance we've put behind us. So let's all work together to continue to grow that fantastic set of numbers. And Moving on to the next slide, we'll get to the really, really good part. Our panel, the folks you came to listen to today. Tom Boddez, general partner at Active Impact Investments. I've known Tom now virtually for a couple of years, and I remember, gosh, the first time I saw you in person, I think was just this year, wasn't it, Tom?
I think so. And for the record, I did actually come here to talk to you as well, Stephen.
He's a very credible liar. I love Tom's investment in the space, and you are actually a trained lawyer. You've actually went to law school. You worked as a partner at a firm for a while before you got involved in impact investing. Isn't that the case?
I was thinking about that when you said I was a credible liar, because I did spend 25 years practicing tax law at Thorstenson's before I became a venture capitalist in the climate tech space.
Fantastic. And a couple of years in climate tech, and a wonderful success from Active Impact to raise a couple funds and make a bunch of investments. And so I'm excited to sort of hear your experience and what you're seeing in the market there. Next up, we've got Julie Angus, CEO of Open Ocean Robotics. I was, to be honest, cruising on Julie's LinkedIn earlier today, and I'm always interested in how people end up as CEOs of clean tech companies. And you have a degree in molecular biology, and now you're making robot boats. I would love to hear how that all came about.
Yeah, you don't end up with the career you think you're going to, that's for sure. But it's an interesting journey.
Fantastic. And Julie, you are currently in the process of raising funds, so you certainly have some opinions on what the capital markets are feeling like at this time to you versus what they felt like in the past. And I'm excited to kind of dive into that.
Yes,
in a minute.
absolutely.
After I introduce Dan Gardiner, who is Vice President at KPMG Corporate Finance. And Dan, I'll be honest, you're the one on this panel that I know the least well. So I will spare you my attempts at humor and just let you move into, you actually have a few slides to share with us, because KPMG has a wealth of research and resources when it comes to consulting and finance and all sorts of supports. And so I'll turn it over to you to talk a little bit about what you're seeing going on in the markets at this time, and then we'll jump into a bit more of a discussion, if that's all right.
Amazing. Thank you, Stephen, and good morning, and good to meet all of you. Happy to be here. My name is Dan Gardiner. I'm a Vice President in the KPMG Corporate Finance Group out of Vancouver. Most of you may have heard of KPMG and think of the firm as a giant audit and tax firm. I work in our investment banking division, so my day-to-day life is helping entrepreneurs like yourself running through different strategic decisions, whether it's raising capital in terms of minority round from venture capitalists, looking at potential debt solutions, and hopefully eventually achieving a successful exit one day and crystallizing all of the value that you're working so hard to create, in addition to the missions and that you're working to solve. So just wanted to start off the discussion on the next slide. I know when you talk about capital markets, there's always a lot of background noise and headlines, and you hear all these stories about inflation and interest rates. And so just want to kind of anchor the discussion with a quick snapshot view of the last decade and some of the key parameters that drive underlying capital markets activity. So if you start by looking at the chart on the top left, this is basically a proxy for economic activity in terms of real GDP. So you can see obviously the one big trend that jumps out of the screen is March 2020 and the months following that. So you see that was those scary couple of weeks and months where our world kind of ground to a halt. Real underlying economic activity was effectively put on pause and then came roaring back. So over the last few quarters, we've seen a return to economic growth and a lot more activity. And I think everyone feels a lot more excited about being back to closer to our past regular lives. The chart on the top right is the Consumer Price Index, which is the measure of inflation. So you can see, again, this is just the numbers behind the headline. This morning, there was a read on the US CPI figure, which came in at 7.1%. So the headlines that you're seeing a lot right now, and kind of the narrative is kind of, has inflation peaked? Is it going to start to normalize based on the actions that central banks have taken over the last few quarters. So it seems like this morning potentially reinforces that trend. Potentially too soon to tell. U.S. inflation peaked at 8.2% a few months ago, and this morning the read was 7.1. So still extremely high relative to the last decade, but potentially flattening out and hopefully on the decline. The bottom left chart shows central banks' prime interest rates, and so this is the tool that you hear in the news all the time of bankers and talking heads on TV speaking about the tools with which they use to fight inflation. And so you can see in 2022 a number of kind of step changes where we've increased the inflation rate in order to try to slow down some of the economic activity and hopefully get inflation back under control. And then the bottom right chart just kind of brings all of that back to a question that is probably top of mind for many of you, which is, what does that mean for my business, and what does that mean for my my potential valuation in a capital raise or exit scenario? And so you can see again a large spike with the bull run that we had over the last 2 years, and then some of the sell-off where we've normalized back much closer in terms of the S&P 500 price to equity multiple. We're now much closer to historical long-term averages. So again, just wanted to start with the overall kind of macro backdrop, and then move into the next slide, which is more of a double click into the clean tech industry, which is where all of you operate. And again, looking at the high level numbers, there's always a lot of different stories underneath the surfaces. And so clean tech is an area that has been growing exponentially over the last decade. So starting with the chart on the left, this shows global clean tech investment activity in terms of dollars raised and number of rounds per year. So you can see 2021 extremely active, breaking all sorts of records. That's true for a number of different industries, including clean tech. And 2022, again, if you ignore the blip in 2021, there's huge tailwinds to this industry as investors want to put their money behind missions that they believe in, and entrepreneurs continue to create unique and compelling solutions to the global climate crisis and other issues that are facing all of us in our day-to-day lives. So I know a lot of people talk about kind of less activity or noticing a slowdown. And so I love this chart because it just puts things really into perspective of if you only are looking at 2022 and 2021, sure, the numbers are a little bit lower, but if you take a step back and zoom out a little bit, this is an area of the economy that continues to attract a ton of investor attention and continues to grow and receive support from investors worldwide. The chart on the right summarizes the most active global clean tech investors, and the trend you'll notice right away is there's a lot of kind of incubators or seed or early stage investors really writing a high volume of smaller check sizes and then providing support similar to Foresight to their kind of cohorts of investees or incubated companies. And I just want to mention a couple other headlines that came across my ticker screen this morning in terms of Canadian investors. So NBC, which is a government strategic investment fund in British Columbia, announced this morning its first 3 fund investments, one of which is EVOC Innovations, which is a clean tech fund focused on decarbonization and other verticals. Raven, which is an Indigenous-led and owned VC fund, and Yaletown as well in one of their new innovation funds. So again, just to throw some names out there, there is a thriving Canadian ecosystem, and there's a lot of capital that's going to have to be put to work in the coming years. Innovobot out of Montreal this morning announced an initial $14 million close for their fund. And last month, BDC Capital launched its second climate tech fund for $400 million, bringing their total climate tech investment pool to over $1 billion. And so I know a lot of these logos are from American groups, just because they are typically a little bit more active. But I just wanted to shout out some of the funds in Canada and specifically in Vancouver as well. We have Tom from Active Investments on the fund which will be great to hear of as a very active local clean tech focused investor. So if we keep moving on to the next slide. On the left, we show a breakdown of the different end verticals for clean tech companies. And so the through line there is really clean tech can mean a number of different things. And so we just wanted to show a mix of different business models and kind of approaches that companies that have successfully raised capital have taken. So you see that mix, the top three, B2B and B2C solutions, and energy coming up as the largest subsegment. And then an interesting trend that we noticed on the right, where we show the mix of clean tech investment rounds by stage over the last 6 years. And you can see the top bar in dark blue expanding pretty consistently. That represents later stage VC rounds. And so on the last slide, I mentioned, hey, there's a lot of kind of early stage investors who are writing a lot of smaller check sizes. This chart to me shows that while that remains true, there is also a shift as the industry continues to mature, and there's more companies that are going on to raise larger rounds later on in their life. So it just shows that in addition to overall dollars and rounds increasing over time, the mix is also shifting. So you're seeing larger rounds from successful startup companies who are scaling and continuing to attract investors. And just on the final slide, I want to talk to fast forwarding a couple of years potentially. So after a company has raised kind of that early first stage, gone through Series A onwards, and then has scaled up and is looking for a potential exit. I just wanted to throw a couple charts up in terms of potential exit opportunities. So this is a summary of the clean tech M&A markets. You'll notice on the left right away, it's a much more sporadic chart relative to the earlier stage investment chart. And this just, again, kind of reinforces we're in the early days of this industry. There aren't really established huge winners that are going to be M&A targets, nor are there large serial acquirers who are consistently rolling up targets in this industry. On the right, we show there has been some M&A activity. It's mostly coming from large global conglomerates who are looking to kind of tag in clean tech solutions to an existing product offering. So you have kind of water, waste management, consulting services, energy, electricity, et cetera, all looking at, hey, maybe we should look outside of our walls in order to find real clean tech innovation and bring those groups in-house in order to help us move forward in the right direction. So through line here, and I'll end the monologue and get into the panel here, but I think it's a very exciting time. The last 10 years illustrate that the clean tech industry has some pretty strong secular tailwinds, a ton of dollars that have been raised that will go into this industry. And so not to jump ahead, but I think my call out for 2023 is I hope that bar on one of the previous slides is even higher next year.
Dan, I think we're all hoping that same thing. And for all of you on the call, we will share this presentation with everybody who's registered to attend. So if you were feverishly taking notes, I appreciate that. But we can share that with you so that you can review it and use it at your leisure. I think, Dan, thanks for preparing all those notes. And I think it was some interesting sort of takeaways. Certainly that first slide where, or the second slide where you're sort of saying, yeah, 2022 was lower than 2021, but still a lot better than 2020. Like things are moving in the right direction. I guess what I would like to, I'll turn it over to the other things, or other folks for sort of their comments. Julie, does that jive with your experience as you're out there fundraising? Is there still a lot of bullishness? Is there a lot of view that like, yes, this is there's lots of kind of capital that needs to be deployed. There's still, a lot of interest out there, or are people still fairly hesitant looking at what interest rates are doing and looking at, what the global economic uncertainty has kind of caused? What's your kind of experience?
Yeah, I would say it does kind of align with what we're seeing. So we just really launched our round a couple weeks ago, but we've had 10 plus meetings and since then and just really good feedback. There's a lot of interest in clean tech. There's a lot of interest in, and I guess to tell you a bit about our technology is we produce solar powered autonomous boats for ocean data collection. So really providing data that's more affordable, more sustainable, more easy to get, and targeting, offshore energy, defense and security, environmental monitoring. So I would say, data continues to be important, and data from the ocean. And we've seen specific funds focused on the ocean economy, whether it's Propeller or S2G, startup this last year. So we're seeing a lot of investment in that space. We're also seeing a lot of customer interest in this space. So whether it's the growing offshore wind industry in the US and looking to get data, or whether it's, the US Navy and their $2 billion plus investment in these types of uncrewed platforms just this fiscal year. So I'd say there is strong interest, yes.
Still lots of positive news there. Tom, yourself, you're sort of, how are you seeing it as it comes to your side of the table? When are you seeing lots of interesting deals, and are you seeing a lot of appetite from your fellows? I know a lot of times you kind of syndicate or you work with other investors. Are they still really active? Are they sort of waiting? Is it harder to kind of syndicate deals if there's something you want to lead on? Or other folks jumping in to kind of lead on deals and bring things along to you? Or how is your experience of the market?
Yeah, and just to set the stage, so we're focused on seed stage. So, Dan went through there's the different stages and different levels of activity. So at seed stage, we're doing almost exclusively seed stage and exclusively climate tech. So for Canada, that we're the largest seed stage climate tech fund, and there's some others in the US, like for example, Lower Carbon on the chart there that have got some notoriety, and lots of other funds that focus there. But if you're looking at just focusing on seed stage, that's where we are. So when it comes to how it's been for us and in the current market conditions and how it's been with other investors, I mean, one saying I saw recently that I latched onto is, I heard that there's a recession, but I've just chosen not to participate because, in any recession, there's still going to be companies that do great and companies that don't do great. I mean, overall, it's, activity is down a little bit, but it doesn't mean you still can't outperform if you're pressing the right buttons. And certainly when it comes to the climate, the climate is certainly not planning to participate in any recession. It doesn't really care what the markets are doing. It's going to do what it's going to do. And so there's still been lots of deal flow where things changed dramatically from 2021 to 2022, or some of the changes are, evaluation, of course. So there's a lot of uncertainty, like what is the right valuation? It's kind of like, it's the same as what you would see if you have a stock portfolio where it's like, wow, my portfolio was worth so much money in 2021 and it's way down. Well, but it's still up compared to where it was in 2020. So is this good? Is this bad? Like, is it fairly valued? Is it high? Is it low? Where's it going to go? So a lot of people are, having those same sorts of struggles to figure out valuations for companies. And what it's actually meant, like some venture capital funds are just on the sidelines, but not investing as much. I don't think there's that many of those really, but I do know a few. And where I see a lot more what's happening is a lot of funds that were really willing to jump in and lead are a lot less willing to jump in and lead. And I think it's because they're trying to get a handle on, if I'm going to lead around, like what is the valuation that should be on this term sheet? I don't want to have a valuation that's completely wrong for the market, and it's hard to know what's right. So there's more that are kind of waiting for somebody else to set the terms, and so all of that kind of makes it a harder environment to raise than it was last year. But in climate, I don't think it's there's still lots of opportunity. So yeah, I mean, if you compare to 2021, a lot harder, but I think the climate tech sector is a lot more resilient than a lot of other sectors, and so still lots of opportunity to raise money.
Absolutely. And good news. I like to hear positive things just before Christmas time. This is the time to leave everyone on a high note. Dan, I saw you nodding along there, agreeing with a lot of what Tom said in terms of the resilience of the climate tech sector. And an interesting point around the valuation. Is that something that you're kind of hearing at KPMG? I know you talk to a lot of different folks and you consult on a lot of different deals. And how do you have any advice on how people kind of should prepare in their raise to have those conversations around their valuation?
Yeah, absolutely, Stephen. No, I agree with what Tom said as well. I think there's a lot more uncertainty, and that's usually one of the last numbers that everyone kind of is looking at each other and waiting for. Maybe asking the company to throw out, hey, like, can you give me some guidance? Like, where's a number that you would absolutely not transact at? And we get that question every day of, hey, like, help me out a little bit with a bit of a range on where you think the value should land for this one. And it's tough, like what Tom said. I think we're coming out of a period where folks were fairly trigger happy and underwriting pretty aggressive growth profiles. I think it really just comes back to the fundamentals, right? So like what is your target market? What is your monetization model? What are your unit economics? And what are going to be the bottlenecks to scale? And how does this capital help you level up and capture that business? And if you think about any valuation, I know a lot of folks will use kind of multiples, or self-included, as kind of a shortcut to get to a value. But really, I think people are going back to the drawing board and looking at kind of discounted cash flows and saying, hey, like, what does this business model actually look like, especially in clean tech and climate tech, where like there isn't a great cohort of public companies that you can go and look at and point at someone and say, hey, here's a perfect comp for me. I'm going to be able to go public in 3 years and capture this value. Here's what your exit is going to look like. So I think there's a lot of time really spent on like bespoke valuation, depending on the value that you're intending to create. And so I would say do what Julie's doing, have a bunch of conversations, talk to all of the right investors, and let the market speak. You're talking.
Well, Dan, at least you cut out for me a little bit there.
Oh, apologies. I was just going to say it to end off my response. I think do what Julie's doing. Talk to many different investors. If you're having one conversation, who knows if that's the fair market value, right? It might be close, but it might not be. And so talk to all of the right folks in your sub industry who are up to speed and smart, and they'll come back to you with a range of offers, hopefully. And from there, that's kind of your market value.
Right. And I sort of saw on one of those slides you were saying that the price to earnings ratio has come down a lot on the public markets, on like where there's lots of data available. But in these private transactions, do you sort of see that that's actually impacting how people are seeing the private transactions? The valuations are a little bit lower as a result of what's happening in other places, or is it really so one-off and custom and bespoke, and whether they believe this story is going to be really good or fantastic? How are you sort of seeing that play out?
Yeah, it's a good question and a hard one to give a direct answer to, but I'll say two things, right? So capital market prices, everyone's always going to have that public market price to earnings ratio in their mind. And so that's always a baseline number that's going to trickle down into private markets. So people are always looking and saying, hey, if the whole market is underwriting a multiple of X, maybe mine should be X minus 30%, because there's added risk of holding private securities, and you don't have liquidity, and there's a whole bunch of different attributes of holding shares of private companies versus public companies. So that's usually a starting point, is thinking about what are the public markets trading at. I'm usually going to discount that a little bit. And then I think that's when you get into kind of the every business is a snowflake analysis and saying, okay, well, you know what, clean tech is an amazing sector. I think there's going to be a ton of growth here. This is a unique value proposition, and you have a huge end market. So I think you're going to grow significantly faster than that. And so then maybe you say, hey, maybe it's not X minus 30%, maybe it's X plus 10%, or somewhere in that range. And so I think you always have to look at capital markets as a starting point, and then you kind of build up the building blocks based on the unique attributes of the business that you're speaking with.
Okay, awesome. And Dan, actually, I had a question about that. I didn't want to interrupt your flow at the time. You had this wonderful red line of average 17 and a half. And it looked like during the graph, at least like 2012 and 2013, it was way down low at like 12. That 17 and a half is an average over the last 20 or 30 years. Obviously, those PEs were...
That was just over the last decade, actually. So
okay.
Yeah, it's a good question. That's actually quite elevated relative to the longer term historical average, which is around, let's say, 9 to 12%. So over the last decade, overall multiples have been quite inflated relative to like the last 100 years. And then if you just look at the last 2 years, there's that whole other blip on top of that. And now we've, quote, come back to a relatively normal level of 17 times. But it's a great question, Stephen, because that still is quite elevated relative to the long-term history of capital markets.
Okay, thank you. Julie, I wanted to ask you, how is this all? You're sort of saying it feels all right. There's still a lot of interest, but any sort of worry in the capital markets, how has this affected your strategy as you go out to raise your round? Have you, anticipated it would take longer than other times? Obviously, we've got the Christmas break coming up here for a couple of weeks. It's going to slow things down for you a little bit. Are there any other kind of adjustments that you've sort of made yourself as you're going out here? Like, are you expecting, and Dan sort of mentioned, talk to lots of people? Are you expecting you're gonna have to talk to even more people than you otherwise would have? What's your what's been any adjustments you've made, or none at all, because solar power boats are fantastic?
Well, solar power boats are pretty good, but we definitely have, considered, some of the challenges in the marketplace to date, and budgeted starting our raise earlier, having a longer runway, so that if it does take longer to close, we have that availability and we're not in a cash crunch. The other thing I would say is that, we're at a different stage in our company's growth now than we were raising our previous rounds, and we're raising a Series A that's really allowing us to scale to meet that customer demand that we're seeing. So, we've sort of demonstrated that the value proposition, have contracts in place with customers, and now we just need to be able to meet that need. So that's a strong value proposition, and has, more quantifiable returns that we could demonstrate to partners. Also, we've been having discussions with funds for years now, and a lot of these funds invested in companies that are later stage, and even though they wouldn't have invested in us 2 years ago, now we've kind of finally approached that area where we are in their sweet spot. So that means they know us, they've been watching our progress, so it's more of an update and continuing to build on that relationship. So I think those are some of the ways in which this raise is different from the previous ones, I'd say.
Okay. And Tom, a lot of what Julie has said, customer traction, having a relationship, these are things you hate, right? You want people to pop out of the blue, free revenue. But in all seriousness, are those kind of good steps to take, where build relationships with people over time, look down the road and say, where am I going to be? Is that what you sort of like to see from the ventures you're working with?
Yeah, 100%. I mean, sometimes we'll see a company that's, not even at seed stage yet, but you can see that it's a great founder and it's a great idea, and we want to stay in touch with them. We put them on our watch list, and we hope they'll stay in touch with us and have some regular discussions as we go along, so that we can track how they're doing as they approach the stage where we typically invest. And so to the extent that Julie's been doing that, now that she's coming to a Series A raise, funds that typically would invest in the Series A, she's going to have a lot more success with funds that have been tracking her and know her for 2 years than when she's just meeting out of the blue, because they've already got an idea of what they're dealing with.
Right.
Also, sorry to jump back in with another point on that, but it's always interesting to check the truth factor too, right? Because you get, sometimes you get founders that have some pretty sharp looking hockey sticks on their graphs, and you say, well, that's great, I hope that happens. And then they come back to you after you've been tracking them for a while and you say, so how did that go? And it didn't quite go the same way as the hockey stick on the graph. And sometimes it did. So it's always good to sort of check, you can check back on what they thought they were going to be able to accomplish over 12 months and what they actually did accomplish, and see how well it matches up.
So regardless of the state of the capital markets, if you've got relationships with folks, that's going to stand you in good stead. Have you adjusted at all any of the things that you do? Like, is your due diligence, you sort of mentioned that valuation you've seen is a little bit more challenging, and some other folks have been more hesitant to apply a valuation. Are there any, do you then have to dig deeper in the due diligence and like really think harder about where the numbers are going to come from? And, to Dan's point of like, okay, well, is it closer or further from what the standard market would price this as? Does that stretch out the timeline? Does it make it a more grueling process, or is it pretty much the same as it was a few months back?
Yeah, so a few things there. So, at the height of things, like late 2021, sometimes you had to get into a deal and write a check before you even you weren't even sure you remembered the founder's last name. That's how fast the deal was moving. So we've always been a fund that tries to pride ourselves on understanding what founders are going through and trying not to be a bottleneck on DD, and like moving faster on DD than almost anyone else. Even at that, like there were times last year where, okay, like if we want to get in this deal, we have like 48 hours to figure this out. Otherwise, that ship has sailed. It's not like that anymore. So things have slowed down. More expect that the due diligence processes will take a little longer, which is good for us because we tend to go fast. So if other people are like going, starting to go longer now because they feel like the pressure's off, that's good. It gives us a chance to get our job done before they figure out what they want to do. And then on the valuation side, at seed stage, it's not, it's very difficult to know what the right valuation is at seed stage, right? Like you can look at a seed stage company and think like, oh, I think this is worth $10 million based on some multiples, and the deal is going to happen at $15 million, and you could say like, oh, that's too steep for me. I'm staying out. I'm staying disciplined on valuation, which we do try to do, but at the same time, like if you believe in that company and it's going to go to $1 billion, you're not going to care very much about whether you got in at 10 or 15. So valuation you have to take with a bit of grain of salt. It's really more a question of like just for in talking to founders, getting them to understand like here's where the market is right now. You may have thought you were worth 15, but the market now is different than it was last year. So maybe it's 10. And really get them to think about like, okay, well, if that's true, if I want to raise the same amount of money, I'm going to get more diluted. So if I'm going to get more diluted, what am I getting here in terms of a partner? Because I'm bringing on a partner. I don't just want a check that's money and nothing else. So, for us as more of a platform type VC model where we're trying every day to work with the portfolio companies to help them with their sales function, to help them with their hiring function, to help them with their fundraising, talking to the founders that we're going to invest in to say, look, like if you have a little lower valuation, maybe take a little less money if you don't want to be diluted. But the important thing is to partner with someone that you're comfortable with, that your values aligned with. It's going to help you get to the milestones you want to get to, so that when you're doing that Series A raise, and hopefully you're doing it in better economic times, you're going to be very attractive to all of this money that's actually been piling up. There's a ton of dry powder at later stages ready to invest in climate tech, right? So you want to be the company that gets attracted to that money.
Right. Armin appreciates the way that you explained that, Tom. And quick reminder to everybody on the call, if you have questions, if you want to ask any of these folks anything, let me know. Otherwise, I will continue to satisfy my curiosity. And actually, I'm going to go to Dan. And Dan, is this a good or a bad thing? Because, Tom's sort of saying, isn't it wonderful that, there's this rush and this pressure and these high valuations, but if this is a return to a more normal, right, even you're sort of saying 16 is historically high for price earnings. If this is a return to more normal valuations, you don't want a super high valuation. And then in a couple years, maybe you have to do a down round, or, is this actually better? And maybe where you're forcing an investor in within 48 hours and they're not really sure your last name. I love that, Tom. They're not going to be very helpful and supportive, and they're not going to be that great partner that you need to move forward with. Are there some upsides to, maybe not getting that massive valuation?
Yeah, no, absolutely. And I use just to speak to kind of the due diligence process, I've been using the analogy of like buying a house. And I would say last year, there were a lot of people who were doing called like drive-by due diligence, where they're in their car, they take a look out the window, the lot's there, there's a building on it, I'll buy it. Today, people are hiring inspectors, they're taking a look at the foundation, they're walking into the house, they're looking in every room and looking for mold. They're doing full on DD. And maybe I'll switch from using normal and say a healthier valuation, right? Because it certainly is a double-edged sword, right? There's founders out there who hit the tail ends of the kind of the venture bull market last year, who have astronomical multiples, and that puts you in a scenario where those investors were underwriting maybe a 5-year growth plan, but only a 2-year runway or an 18-month runway. And so what does that do to founder psychology? Like, you now have to bring forward 5 years of growth into an 18-month or 2-year time frame just to get back to break even. So it puts raising at an inflated valuation, I think, puts a ton of pressure mentally and operationally as well, because these investors are going to say, hey, well, we don't want to have a down round. They're going to say, hey, well, here's the forecast that I presented to you. Where do you meet in the middle? It's you have to grow faster to counteract the multiple just in order to stay flat. And so I do feel for folks who might feel like they're on a runway if they raised on a bit of a treadmill, if they raised at the highest possible multiple without thinking about the downstream consequences of that and what that'll look like for future rounds. So I'd say absolutely be thoughtful about term sheets that you're looking at. And to Tom's point, it's not all about having the highest sticker price. It's about having the right team of people behind you, the right folks on speed dial that you can call when you have a question, the right people in the boardroom with you, and the right investment structure so that you're still inspired every day because you own a big enough piece of the pie that you're going to come to work excited every morning. So yeah, I think valuation, having nice big numbers feels good in the moment, but I think being thoughtful about the longer term implications of that is absolutely important as well.
Thank you very much. I think it's a nice balanced one. I have a question here from David Caldwell from 3F Waste Solutions. What if the valuation you've arrived at is really, really high, such that people don't kind of believe you? Would you tweak that down to fit within a more conventional range? I'm actually going to ask Julie, what's your opinion on that for David? Would you, if you're coming up with a crazy valuation, would you sort of work the numbers back and sort of say, you know what, let's be a little bit more conservative and come in where it's going to be maybe easier to have a conversation with folks versus, if you really do have your realistic case has that crazy hockey stick that Tom talks about. What would you do in that case?
I mean, if it's defensible and you can show the supporting evidence for it, definitely, I would share that with investors. You're going to get feedback on your, the evidence that you provide and, the valuation that investors are going to think it's worth. So once you start to talk to multiple investors, it'll be interesting to see the traction you get and the feedback you get, and then start to incorporate some of that in your modeling and the way way that you present things to people, because that is the one one of the many interesting things about going out to raise is the feedback you get. And it does sometimes make you look at your business and your business model differently, because these are people who have, broad experience across many different companies. They're comparing these different markets, and that can be something that can help you present the company in a way that's easily understandable, and you can sell it.
Right. And Tom, is it a bad thing if people have projections and then exceed them? Like if they kind of, if they sell you a story and then they blow it out of the water, is that a bad thing? Or do you think that they maybe hurt their valuation? So in the case of David, if somebody comes in with a crazy high number that you have trouble accepting, that's not good. But do you ever see companies come in with a projection and they actually can exceed what they told you to do, they would be able to do?
I'm not sure if I'm understanding. I was looking at David's question, and it was around valuation being so high that people don't believe us, as opposed to the revenue.
Well, I'm assuming the valuation derives from some potential future value. I don't know.
Yeah, sometimes. I mean, sometimes it might be that the founder, for whatever reason, type of business, whatever it is, has a pretty significant multiple on their revenue compared to what you would expect. I just think I think the important thing is so there's David with, it's the future value of our products and IP. So so David's saying to the market, like, we have what we have is going to be extremely valuable. Like, don't get yourself too focused on what our current revenue is. Look at what we're building, and he's saying that some people aren't seeing it the same way he is. I'd say to that, like, there are a lot of venture capital funds out there, and a lot of them are going to say no, and a lot of them are going to say no. Almost all of the ones that say no are not saying no because they don't like your business. It's something else. It's like, it's not their model. It's not what they're good at. It's not their stage. There's like 100 reasons why they're going to say no. So if as a founder, you've done your homework in terms of, seeing what the landscape is in terms of who are the funds out there and which ones will get it. So, I don't know your business, David, but there's going to be particular funds that are going to get it and are going to have a very strong sense of whether they should be putting that valuation on it or not. And like Julie said, they might give you some feedback that makes you reconsider whether it's right or not. And similarly with Julie earlier talking about, there's some funds that have popped up now that really understand the ocean space. That's their whole focus. Their whole focus is on oceans. Obviously a very strong fit, right? Like, they're going to understand what Julie's talking about and what she's working on a lot better than a fund that does not touch that space. So if you find your people, if you put in the hard work of like figuring out which fund's going to be a good match and that understands what you're doing, you're going to get a pretty good sense of whether you're right and what you're saying on your valuation. Sorry, I don't know if I quite answered the way you wanted to, Stephen. But
no. I think that's good advice, right? And at the end of the day, it is to Dan's earlier point, like finding that fair market value of talk to a bunch of people, and if nobody's willing to pay you what you valued your company at, then to Julie's point, you might have to change how you value your company. But Tom, great advice. Find the people who are going to understand how you valued the company.
Yeah, can I put in one more point on that too? Like, doubling down on what Julie said about like taking and incorporating the feedback, because there's a company I have in mind right now that shall not be named. It's an American company. They went out and said, this is what we want our valuation to be. They tried to raise money for 15 months, including during 2021 when times were great. And could not do it because the founder was stuck on, this is what my valuation is. And meanwhile, the company, like, cash was going out the door like crazy and like, coming close to zero, and nope, this is my valuation. Well, I just heard last week that company has finally raised money at a fifth of the valuation. And, I also heard that that company turned down a valuation that was about a half of what he was asking for 6 months ago. So, there's a lot of value in getting your fundraise done and moving on. So incorporating the feedback you're getting is smart.
I think just to follow up on that point, Tom, your runway is really important. And the closer you get to that end of the runway, the more pressing it is to get that raise. So you'll have more leverage early on when you still have enough cash to execute on your development and your milestones.
Awesome. Thank you all for those comments. Quick question from Christopher Moreno. A flat round is the new up round. Following on from what Dan sort of said, where people maybe raised money in 2021 or late 2020 at really high valuations. Tom, how would you see that as an investor? Would you sort of say, yeah, this is okay? Like you're not showing increasing value. Is that fair? Is that what other people are sort of saying?
I was just sitting here thinking, pick me. Because I have something to say about this for sure. Well, so I don't know. I'm going to go back to what I said at the beginning. I heard there's a recession and chose not to participate. So, like, we have had six follow-on investments happen this year. They were all up rounds in our companies in Fund One. So that would suggest that it's not necessarily the case, right? Like maybe if you're like, okay, if we're gonna go to statistical averages. There's going to be a lot more that are like that, but every company is a different story. Like back to what Dan was saying, there's one company in our portfolio. They were fortunate to raise a large amount of money towards the end of last year, and they're in that situation of like, okay, how are we going to grow into this valuation? And the company is doing exceptionally well, but it's still going to be a challenge to get back to a flat round for them, just because they raised their last one at the absolute euphoria. But yeah, I mean, it's a case-by-case situation. I think if you looked at the averages, you're going to see, a lot fewer dramatic up rounds than what you were seeing in 2020 and 2021. You will see more flat rounds. You'll see down rounds. But I've heard people make that comment before and it's you can't agree with it when every company is a different situation, right? Like be the company that isn't that.
All right. A real quick question on safes from Jesse Hebert at Okius. Are they being used more for seed stage? Dan, do you have kind of an opinion on what you're seeing on the side of safes, on where they're being used, when they're being used?
Yeah, and I'm interested to hear Tom and Julie's perspective on this as well. I've definitely seen the safe as an instrument used a lot more liberally in the last couple of years. And so originally it started out like this is the concept of like a friends and family round or like a small incubator round where you're doing a couple $25,000 checks or maybe $500,000. And I've seen multi-million-dollar safes from institutions in the last year. So I think to that point, if you struggle with valuation and you get to that kind of bid-ask spread between what a founder is stuck to mentally and what kind of the market feedback is there some way to get creative and use a safe as kind of an instrument to bridge that bid-ask spread by using something like a valuation cap and saying, hey, let's put the valuation cap here. That's kind of what we think. But if it's below that, you have some dilution protection, right? So I've definitely seen it used more and more, and increasingly, from my perspective, in ways that it was not originally intended to be used.
Very interesting. Tom, your perspective really quickly?
Yeah, there's been a lot more safes being used lately. It typically is, I think, in situations where nobody wants to try to really figure out what the right value is. We'll do a safe if we have to, but like preference on our end would be, let's put our heads together with the founder and hopefully be able to come up with what both sides think is a fair valuation, do a priced round, and then work to get to that next level for the next raise where you're going to be able to raise an up round.
And then Tom, Jordan's follow-up question, are they becoming less appealing given the, less up rounds or does it change, do the current conditions change your view on safes at all?
Yeah, I wonder from whose perspective we mean, because they're not appealing to me. Like, if you're going to have a safe that is at a discount to the valuation in the next round, and you're a VC fund that is, priding yourself and doing your very level best to do everything you can with the platform approach to get to a significantly higher valuation by the next round. I'd rather price it and then help them get to like a 3x valuation than have a safe that's at a small discount. So from our perspective, that's why I don't like safes. I think there would be other VCs that don't have a platform approach that are just betting on this company in the very long term and are happy with a safe. So yeah, it depends. And then from the company's perspective, I mean, maybe Julie, you want to jump in there. What it's like from the company's perspective, but yeah, I'll leave that one aside.
Yeah, from a company perspective, we like safes. We raised 2 small rounds on safes. They're easy and affordable to close. They were relatively small rounds, total raised under 2 million. And then we're doing a priced round this time where those safes will convert. I think there is a lot of value for those early stage companies with a safe, like Tom said, valuation isn't something you have to agree on. You can have a discount and a cap, so that protects the investor against the downside as well as against the upside. So I certainly think they do have a place. The round we're raising right now is 13 million, so far beyond that safe category. So I think you need to be cautious. Safes can be dangerous if you continue to invest on a safe and then you really don't have a good idea of what your dilution is going to eventually be when you do convert. So they do have a place. We found it effective. Obviously priced rounds are really critical to at the right stage for a company, even if you do raise on a safe.
Okay, we're almost
Really,
out
I
of
like
time.
that point.
Yeah.
That safes are dangerous. Safes can be dangerous, right? And I always say simple is in the name, but they're far from simple. I've seen people who start to stack different discount rates, different conversion caps, and then you get to a point where like the math gets pretty convoluted and complex. So I'd say great instrument for what they're intended for, but they can be dangerous. So be thoughtful about using it for the right application. Absolutely.
Absolutely, and I think that's true across any type of investment. You want to keep it simple.
Really quickly, we've talked about the frothy highs of last year, the healthy or maybe more realistic things that we're seeing now. What's your prediction for the next 12 months? Is it going to get worse before it gets better? Is it going to stay the kind of way it is? What do you think is going to happen, Dan?
Yeah, Stephen, starting with me, appreciate that. Look, I started off the call talking about the fundraisers that were literally in the news this morning. So it's hard to go a day without seeing more funds raised from an investor perspective, as well as more rounds coming soon. So look, I think clean tech and climate tech is a subset of the broader industry that we need to pour money into. Governments are backing that, private investors are backing that, and there's a bright future with inspiring entrepreneurs who are building compelling solutions. So I would say hopefully up and to the right, and I would love to check in next year, hopefully with a taller bar chart. That's my take. Thanks.
Fantastic. Thank you very much, Dan. Yourself, Tom, what do you think happens next year? What's up for 2023?
I think I've gotten old enough to realize I should stop trying to predict what the markets are going to do, because I'm usually right, but at the wrong time. Happens at a completely different time than I thought it was going to. And then I go, see, I knew that was going to happen. Yeah. So next year, I think we're not going back to 2021 anytime soon. I'll put it that way. I expect more of the same, at least through the first part of the year. But when I think about climate tech space, a couple of things I think about is and back to my initial quote, right? Like just choosing not to participate. Like there's lots of tailwinds, as Dan said. And so if you just focus on building a great business, I do know for sure that eventually economics are going to change in the markets more broadly. And I do know that climate tech is going to be something in high demand. And I do know that there are funds sitting on oodles and oodles of cash that they want to invest at, Series B, C, D, and beyond. Billions of dollars of dry powder sitting there. So I think the key is to just, buckle down and batten down the hatches and build something great. And eventually the time's going to be right for it to really be matched up with strong economy and lots of capital available.
Absolutely. And Julie, how are you how are you seeing the next year unfold, specifically in your context, but more generally in the markets? How do you think it affects entrepreneurs, and do you have a piece of advice for the folks on the call?
Yeah, I would agree with everything that Dan and Tom have said. I think we're going to continue to see growth in climate tech companies and support for them because we need this technology. We're seeing investment specifically focused on climate tech. So I think you're going to see companies growing across all stages and continuing to advance and be supported for that growth. And I certainly hope that turns out to be the case.
Fantastic. Thank you so much. Well, to you all, Tom, I hope you raise another fund next year, continue to pick wonderful winning investments. Julie, I hope you close your current round and continue to win commercial contracts for your wonderful autonomous boats. And Dan, I hope that your predictions are 100% correct and next year sees lots of great big investments, big numbers, big dollars, and big results for the clean tech industry. Thank you, everybody, so much. I wish you all a very happy holidays if I don't talk to you before the new year. I would also like to remind everybody, if you know anybody who's interested in getting some support from one of Canada's clean tech accelerators, we do have applications open until January 5th for our next cohort. So please share that link. You can scan the QR code. It's probably pretty much everywhere on our website, maybe a few places on LinkedIn. And I look forward to having a conversation with you all next year.